Imagine this for a moment. It's a Tuesday morning in February. Eleanor, a 64-year-old grandmother in North Carolina, sits at her kitchen table with a cup of tea and her laptop open. She started taking Social Security 2 years ago at 62, just like a lot of her friends did. And last fall, when her grandchildren needed help with after-school care, she took a part-time job at a local boutique, 25 hours a week. Nothing fancy, just enough to help her daughter and put a little extra in her pocket. Then the letter arrived. It's from the Social Security Administration. She opens it slowly, and she reads 3 sentences that make her hands start to shake. Her Social Security benefits will be withheld, not reduced, not adjusted, withheld. For the next several months, her deposit will be $0. She owes the government over $7,000 in what they call excess benefits. Eleanor never broke a single rule. She paid her taxes. She reported her income. She went to work every day like a responsible person. And yet somehow, the United States government is telling her that by working a part-time job, by trying to help, she has triggered a federal cap that almost no one warned her about. If you are over 62, if you are collecting Social Security early, and if you are working any kind of job, even a small one, please do not click away from this video. Because what I am about to show you is a cap that has been quietly sitting in the law for decades, and right now, in 2026, it is reducing benefits by an average of $7,000 per year for hundreds of thousands of working retirees just like Eleanor. I am Masha. I am a senior policy analyst, and I help retirees make sense of the rules that are quietly draining their retirement income. Today, I am going to walk you through this exact cap. What triggers it, who it applies to, what does not count toward it, and the precise steps you must take to protect every dollar you have earned. And please, stay with me until the end. Because there is one specific mistake, a mistake that happens in the first year you start collecting Social Security, that can cost a working retiree their entire benefit for half a year. Most seniors have never heard of the protection that prevents it. By the end of this video, you will know it by name. Let me tell you a story. Robert is 63 years old. He lives in Michigan. He spent 38 years working for the same auto parts manufacturer. When the plant downsized in 2024, he took an early buyout, and at age 62, he filed for Social Security. His monthly benefit came out to about $800, around $21,600 a year. It wasn't huge, but combined with a small pension and his wife's part-time income, it was enough to keep their household running. Then, in January 2026, an old colleague called him with an opportunity, a consulting role with a regional supplier, 3 days a week. The pay was $38,480 a year. Robert thought about it for a few days. He worried a little about taxes, but the extra money would let him finally fix the roof and help his son with college expenses. So he took the job. Robert did the right things. He reported the income to Social Security when they asked. He filed his taxes properly. He didn't hide a single dollar. But Robert had no idea that he had just walked into a federal cap. In May 2026, his Social Security deposit didn't come. Then June, then July. By August, he had received zero Social Security for 4 straight months. He called the local SSA office in a panic. The representative pulled up his file and explained very politely that Robert's earnings of $38,480 were exactly $14,000 over the 2026 limit of $24,480 for retirees under full retirement age. The law required SSA to withhold $1 for every $2 over the cap. That worked out to $7,000 in withheld benefits. And because SSA does not deduct the money in tiny pieces, they withhold whole monthly checks until the debt is paid. Robert got no Social Security at all for almost 4 months. Robert never broke a rule. He never lied. He just didn't know the cap existed. I am telling you Robert's story because the very same cap is reaching into the bank accounts of hundreds of thousands of working retirees in 2026. And the worst part? Most of the seniors who get hit by it had no warning at all. The only protection is knowing the rule before you trigger it. So let me explain it to you. In plain English, the way it should have been explained to Robert. The cap is officially called the Social Security Retirement Earnings Test. It is written directly into Section 203 of the Social Security Act. It is administered under the SSA's internal rulebook, POMS RS 02501.021. This is not a new law. This is not a proposal. This is not something Congress is thinking about. This cap has existed for decades, and it is actively withholding benefits right now this year in 2026. Here is what it says, simply. If you are collecting Social Security retirement benefits and you have not yet reached your full retirement age, for most current retirees, that's 66 and some months, or age 67 if you were born in 1960 or later, and you continue to work for wages, the government places a cap on how much you can earn before they start taking your benefits back. For 2026, here are the exact numbers, straight from the Social Security Administration's official 2026 COLA fact sheet. If you are under full retirement age the entire year, your earnings cap is $24,480 per year. That works out to $2,040 per month. Every dollar you earn from a job above that limit causes Social Security to withhold $1 from your benefits for every $2 of excess earnings. If you will reach full retirement age sometime during 2026, you get a more generous cap, $65,160 per year, or $5,430 per month. And in that year, the withholding ratio is gentler, only $1 withheld for every $3 above the limit. But this only applies to earnings in the months before you actually hit your full retirement age birthday. And here is the very important part. Once you reach your full retirement age, the cap disappears completely. Starting that month, you can earn $10,000, $50,000, $200,000 from a job, and the Social Security Administration will not withhold a single penny. The cap only exists during the years before full retirement age. Now, let me show you exactly how the $7,000 works. A 64-year-old retiree is collecting $1,800 a month, which is $21,600 a year in Social Security. She takes a job that pays $38,480. That's $14,000 over the $24,180 cap. The math is simple. Divide $14,000 by 2, and you get $7,000. That is the amount SSA will withhold from her benefits for the year. Her Social Security drops from $21,600 to $14,600. A 32% cut. That is the cap. That is the $7,000 number in the title of this video. And it is happening right now to working retirees across America. Now here is where most seniors get confused, and where I want you to pay very close attention. Because misunderstanding what counts toward this cap causes seniors to refuse jobs they could have safely taken, or worse, to walk into financial traps they never saw coming. The Social Security Administration is very specific about what counts as earnings for this test, and the list of things that do not count is actually quite long. What does count? Only 2 things. Wages from a job. That's your gross pay before taxes. And net profit from self-employment. That's your business income after expenses. That's it. Bonuses, commissions, and vacation pay are also counted as wages because they come from work. What does not count? This list will surprise you. Pension income does not count. A retiree drawing $40,000 a year from a private or government pension can still earn the full $24,180 from a part-time job in 2026 with 0 benefit reduction. Annuity payments do not count. IRA withdrawals do not count. 401k distributions do not count. Required minimum distributions do not count. Investment income, dividends, interest, capital gains. None of these count toward the earnings test. Rental income does not count. Veterans' benefits do not count. Other government or military retirement benefits do not count. Let me say this clearly. A retiree pulling $80,000 a year out of an IRA and another $30,000 from a pension can take a part-time job paying $24,480 in 2026, and Social Security will not withhold 1 penny. This matters enormously, because thousands of seniors turn down work every year out of fear that their pension or their investment income will trigger the cap. It will not. The cap is only triggered by the sweat off your back, wages, and self-employment net profit. Now I need to address the biggest, most damaging myth about this cap, because it actually cuts in the opposite direction. Many seniors believe that any money withheld is lost forever, that they will never see it again. That is not true. According to the Social Security Administration's own official program explainer on the retirement earnings test, which I want you to look up at SSA.gov, when you reach your full retirement age, SSA performs an automatic recalculation of your monthly benefit. They adjust your reduction factor to give you credit for every month that benefits were withheld due to the earnings test. Over the rest of your lifetime, that withheld money is gradually paid back to you through a permanently higher monthly check. So in a sense, the money is not lost, it is delayed. But, and this is critical, if a retiree does not live many years past their full retirement age, much of that withheld money is never recovered. So while the rule is fairer than it sounds, it still hurts seniors who are short on cash today, and it still creates real financial pain for households that are counting on every dollar of that monthly check to pay rent, buy medications, or cover the electric bill. There is also a second piece of good news that almost nobody talks about. Per SSA's official rules at ssa.gov Benefits Retirement Planner While Working, HTML, every single year, SSA reviews the wage records of all beneficiaries. If your most recent year of work turns out to be one of your top 35 earning years, they automatically recalculate your benefit and increase it permanently, with the increase going back to January of the following year. So continuing to work, even part-time, can actually make your future Social Security check bigger for the rest of your life. That's the silver lining most seniors never hear. So what should you actually do? Let me give you 3 precise steps. Please write these down or pause the video and take a screenshot. Step 1. Use the official SSA earnings test calculator before you accept any job offer. The Social Security Administration provides a free calculator at ssa.gov/oact/RT effect.html. Type in your monthly benefit and your expected earnings, and it will tell you in seconds exactly how much of your Social Security will be withheld for the year. Do this before you accept the job. Do this before you sign the offer letter. Do this before you tell your boss yes. 5 minutes on this calculator could save you $7,000 or more. Step 2. If you are retiring mid-year, formally request the special first-year rule. This is the protection most seniors have never heard of. It is officially called the Monthly Earnings Test, codified at SSA POMS RS 02501.2030. Here is how it works. If you retire in the middle of a calendar year, say you stop full-time work in July, you may have already earned far more than the annual cap of $24,480 from your old job. Under the regular rule, that would mean no Social Security benefits for the rest of the year. But under the special first-year rule, SSA can apply a monthly test instead. You can receive your full Social Security check for any month from July through December, where your earnings stay at or below $2,040, regardless of what you earned earlier in the year. This rule does not always apply automatically. You have to ask for it. When you call SSA at 1-800-772-1213 to file for benefits in your retirement year, specifically say the words, "I want to invoke the monthly earnings test for my first year of retirement." That single sentence can save you thousands of dollars in benefits you would otherwise lose. Step 3. Report your estimated earnings to SSA in advance, and keep every record. Do not wait for SSA to discover your earnings through IRS wage matching. If you know you will exceed the cap, call Social Security and report your estimated earnings as early as possible in the year. This allows SSA to withhold benefits in real time, in an organized way, instead of issuing you a massive overpayment notice 9 or 12 months later. And remember, under SSA's reinstated policy effective March 27, 2025, the default overpayment recovery rate is now 100% of your monthly Social Security check until the debt is paid. That means a single missed report could leave you with a $0 Social Security deposit for months on end. If you ever receive an earnings test withholding notice that you believe is wrong, For example, if SSA used incorrect wage data, you have the right to file Form SSA 561U2, the request for reconsideration, within 60 days of receiving the notice. Miss that 60-day window, and you lose your right to appeal for the entire year. Now, before I let you go, let me reveal the hidden mistake I told you about at the beginning. The mistake that cost working retirees their benefits for half a year. The mistake is this: claiming Social Security in the same calendar year you stop working full-time without asking for the special first-year rule. Picture a senior who worked full-time from January through June and earned $80,000. He retires July 1st. He files for Social Security. The SSA representative processes his claim. The senior assumes everything is fine. Then he gets a letter saying he will receive zero Social Security for the rest of the year because his earnings already blew past the $24,480 annual cap before he even retired. That is wrong. Under the special first-year rule, that senior is entitled to a full Social Security check for every month from July through December, as long as his earnings in each of those individual months stay below $2,040. But the SSA worker is not always going to volunteer that information. The senior has to know to ask. This single piece of knowledge can mean the difference between collecting a full half year of Social Security and collecting nothing at all in your first retirement year. Now you know. Friend, I want to leave you with this. Do not rely only on YouTube notifications for the rules that govern your Social Security check. The platform's algorithm changes from week to week, and you may never see another video like this one again. The retirement earnings test cap, the income brackets, the appeal deadlines, all of these adjust every single year, and the only way to stay protected is to go directly to the official source yourself. Bookmark SSA Gov in your web browser today. Set up your free My Social Security account if you haven't already. It shows your earnings record, your projected benefits, and any notices SSA has sent you. Sign up to receive paper letters in addition to electronic ones, especially if you are over 65 and live alone. And keep a folder, a real physical folder, with every Social Security letter, every pay stub from your part-time job, and every tax return for the last 3 years. When something goes wrong with the SSA, those documents are your defense. If this video helped you understand even one thing about this cap that you didn't know before, please share it with a friend, a sibling, a neighbor, or anyone you know who is still working while collecting Social Security. The seniors who get hurt the most are the ones who never hear about these rules in time. This is Masha with Pension and Law Unlocked. Stay informed, stay protected, and I will see you in the next one.